Hey, everybody. It is Friday Live with HPK Provident Advisors. Of course, every Friday at 12:30 p.m. Eastern Standard Time, we jump on Facebook and talk a little bit about the market, some planning ideas. Mike, as you know, I am coming to everybody today from Bridgewater, New Jersey. I'm out in Bridgewater today. My son's got some hockey games all weekend. So for those of you who don't know, Bridgewater is about 45 miles east of Allentown, Pennsylvania, and about 30 miles west of New York City. Mike, of course, I am one of the partners and financial planners here, and Mike is our in-house portfolio manager. He's a chartered financial analyst. He's going to talk to us a little bit about what's going on in the markets, which is a ton. But Mike, before we get into that, correct me if I'm wrong, you spent some time in your life in this part of the world.
Yeah, I'm originally from northeast corner of Pennsylvania. So I was born and raised there until I was about 16, and then came down to Florida to go to a baseball academy for high school.
Well, I was wondering, I was driving through here, which is a beautiful landscape out in this part of the world. And it's hilly, but it's not mountainous. So I'm wondering how you got to be such a good skier in this part of the world, because I didn't see any mountains out here, Mike.
I don't know. I guess my dad had me skiing by the time I could walk, so it was just repetition. But now whenever I get a chance, I go out west. I skip the East Coast skiing.
Well, like I said, it's very hilly, but it's not mountainous. Nothing
that impressive there.
No, but it is beautiful. It really is beautiful. And I did get to go to a diner. I'm in New Jersey, so I felt compelled to go to a diner this morning. It was excellent. Hey, all these things that we talk about, as a reminder, it's a bull market in compliance. And so we got to make sure that we get the compliance thoughts out there. Nothing we're talking about today is a specific recommendation for your situation, not on any specific security or sector or region or type of investment. These are just ideas. It's our discussion each week on what's going on. And there's been so much going on. And Mike, we're thrilled to have you because, when I look at this landscape, we'll talk about that in a second. But when I look at this landscape, this is one of those times. It's unique. There's a lot going on. A lot of people feel like, wow, it's different this time. And this is one of those times that could really make a transformational difference in your investing in your financial life, because it is unique and there are a lot of things happening. Michael, let's talk, about some of the headlines. We talk about these occasionally, but I'm going to repeat because it is that important. And I think people will recognize, wow, this is an interesting time. Now, I'm not saying bad. I'm not saying good. But in these interesting times, as an investor, as a long-term investor, somebody's got a good financial plan, these can make a huge difference. We got the oldest president that we've ever had in the history of the United States. We got inflation going crazy. We got Russia causing problems in Europe. We've got a big, powerful Asian nation that is seemingly trying to take us over economically and politically. We've got midterm elections coming up. We've got, this virus running around. We're not sure where it came from or how it's going to affect the future and all these other things. It is just a phenomenal time. Now, some of you have heard me say this before. All those headlines that I just gave you were from 1981. See, because in 1981, Ronald Reagan was the oldest president in the history of the United States. Inflation was 13-14%, whatever it was. Russia in Europe at the time was East Berlin, West Berlin. Very stressful time. The big, powerful country in Asia in 1981 that was trying to take us, it's seemingly trying to partner with us, take us, or whatever it is, economically and politically, was Japan. Of course, it's China right now. Midterm elections are coming up. In 1981, actually, the midterm elections were in 1982, but it wasn't that far off. It was kind of affecting the economic and political landscape. And then the virus that I had mentioned, that we're not sure where it came from, that was HIV. HIV was discovered, was first identified, I should say, in 1981. So a lot of people say these are unprecedented times. It's super unique. What I do know is the people that had the fortitude, in hindsight, it's very easy. The people that had the fortitude in 1981 to say, I've got long-term goals. I'm going to stick with my plan. I'm going to invest for my future. It would have paid off tremendously for them, because from 1982 to 1999 was the greatest bull market in the history of the United States. But why invest in 1981? Nobody would have. It didn't feel like it was right. We're not certainly predicting that the next 17 years is going to be the greatest bull market ever, but what we are saying is maybe history repeats itself. Mike, from your perspective, studying the markets in great detail, are any parallels? Does history at least rhyme a little bit?
Yeah, not only the headlines. So if you look at the stock market during that time period, it's actually a pretty similar chart to what we have today. So in 1981 on the S&P 500, most of the drop that was encountered was in a 6-month period, just like we had this year. And the actual amount that it dropped from the peak in 1980, where I see that bear market actually starting, was 24%, which is also the drawdown we saw this year. Now, if you just go from the high in 1981, it was closer to 20%, but from where the bear market actually started, 24%. So spot on. And then from there, in 1981, there's a strong rally all the way up to the 200-day moving average, which was downward sloping, just like we have today, and then it bounced off. So if you're looking for a chart that could indicate where we're going next, I'm not necessarily saying we're going to follow that exactly. We might not, but it's pretty accurate up to this point. So from there in 1981 into 82, the market moved lower the next 3 months, making new lows, which were about 3% below the previous trough. So right around 28%. And then the good news is from that bottom, there's a tremendous rally over the next 12 months of about 60%. Now, although that chart has many similarities so far, just like some other bear markets that I've been looking at, each cycle has a little of different factors that are shaping it. So even though we have some of those factors in the 1980 to 82 period, really by the middle of 81, they're in their second recession. And at that point, Paul Volcker was cutting rates at that point. But I must mention that was off of about a 20% Fed funds rate. To put that in perspective, we're at 2.25 to 2.5 right now.
Well, certainly not perfect parallels, but we do find it interesting, not only on the headlines, but the market activity. As a matter of fact, I think they called that the Volcker recession or something along those lines. But the point is, in 1981, and certainly now, the Fed is very, very active. Of course, Jerome Powell's out at the Jackson Hole Symposium and some comments that may be affecting market. But what is similar, for sure, and it's fascinating to me, Mike, that some of that study that you have done on the technical analysis and kind of what that all looked like in those parallels. Who knows? What we do know, it wouldn't have felt great to invest in 1981. If everybody goes back in their time machine and says, what did I feel like in 1981? I bet you didn't feel great. And the world ended up just fine, believe it or not. So those, that's just, it's just so interesting that we could be students of this, and those who don't study history are doomed to repeat it, obviously. But Mike, you had mentioned similar other time periods. Can you throw out maybe one or two others?
Yeah, I'd love to. Similar? So this week was History Week for me. I spent a lot of the week trying to and my main goal was to find large drawdowns in the market that also had a downward sloping 200-day moving average, kind of get a picture of what typically happens. So I looked at 1990, the dot-com recession, the Great Financial Crisis, 2011, and some other periods that didn't quite meet that criteria. So what I found in all those periods was none of them broke above the 200-day moving average on the first try. The two with only a slightly downward sloping 200-day moving average were the periods where new lows were not made after bouncing off of it, but they did retract about 5.7 and 10%. Now, those were manual calculations on my behalf, so take them with a grain of salt. But the other three periods, including the 1980 example, had a much steeper downward sloping 200-day moving average. They did result in a recession throughout that period, and they did go on to make new market lows. So I've been talking a lot about the 200-day this week and last week. Why that is important, it basically just shows the trend that we are in. The steeper, whether it's upward or downward, that moving average is, the stronger the trend is. So right now, you look at our 200-day moving average, the trend's pretty weak, regardless of the 2-month rally we just had. But it's important to note at some point we're going to get above that. It's going to be upward sloping, and it's going to lead to a more sustainable rally in the market. So where we go from here, I'm not confident we're going to break the previous lows. And if we do, I would see it more similar to like the 1980s example, where we break that low by a few percent. Nothing extreme like the great financial crisis or the dot-com bubble.
Well, the dot-com bubble and the great financial crisis, boy, they were unique and interesting times. The dot-com, there was a couple of years where the market didn't do well. The financial crisis, the market went kind of was really not good for an entire year. But in each of those periods, even though in the dot-com cycle it was 3 years where the S&P 500 in this example didn't do well, other investments did well, and then not much was doing well. Maybe the 30-year Treasury strip did pretty well in the financial crisis. But going back, for folks that had a good plan, understood why their dollars were in different places, had the right time frames, it worked out tremendously well. And that's kind of the point. And many of you know this, the structure at HPK Provident Advisors, Mike does the portfolios for us, he studies the markets for us and whatnot. And in the simplest terms, if you're sitting around saying, wow, this is really interesting, but I'm not really sure what that means, that's what the rest of us do. So the rest of us on the financial planning side, we take all this information and say, okay, what does that mean to you? How does that really affect your life? So we've got this great resource of the data and the insights and the portfolio management in Mike. And then the rest of us in doing the financial planning and keeping people on track are saying, okay, this is what this means to you as an individual. And that's why we encourage you to work with a qualified financial professional, qualified legal professional, qualified tax professional, so that they can give you the insights for your situation. These are just general comments, of course, but at HPK, that is our structure, is that Mike, studies these things, and then we're able to take it and work with our clients individually and say, what does this really mean to you? So Mike, so there was a sell-off earlier in the week, a bounce back a little bit thereafter. What was driving the sell-off? Does that give us any indication of what might be going on next week? Give us some thoughts on that, if you would.
Yeah, so for the most part, investors just started the week out worrying that the Fed was going to be more hawkish at the Jackson Hole event. But we've been hearing from countless Fed members over the past couple of weeks. And so I don't know why this would be a big surprise. They've all been coming out with a more hawkish rhetoric. And just to clarify what I mean by hawkish, it means the Fed's going to be more restrictive on their rate hikes than what markets were anticipating. So right now, the markets are, even after today, which I'll get into a little bit later, markets are anticipating that the Fed's going to start cutting rates in the first half of next year. I just don't see that as a realistic scenario. The bottom line, this isn't a fairy tale. I hate to say it, but you don't get from 9% to 2% inflation within a few years without causing some economic pain. Now it's possible that the Fed starts to take a different view and say, okay, well, we want to get to 2% eventually, but maybe that can happen over a 4-year period, so they don't have to be as aggressive.
Right.
But right now, and a lot of the speeches I've heard this week kind of coincide with that. I think we need to get to at least 4%. Like I said last week, we've never had a time period where inflation has come down substantially without getting the Fed funds rate to match that level.
Yeah, and this could be one of those situations in our economy with the Fed activity and whatnot. It could be one of those things. And there's so much of what we do in financial planning that can really be summarized. There's a lot of things that we do in our life in general. It could be summarized in a simple concept: short-term sacrifice, long-term gain. On the financial planning side, the short-term sacrifice is I save $1 now, I don't get to spend it, I sacrifice, what my immediate gratification is. The long-term gain is hopefully that grows and you have a few extra dollars for later in life. And that might be the same with the economy, right? Short-term sacrifice, raise some interest rates, slow some things down. That short-term sacrifice hopefully could lead to a long-term gain. And I kind of look at that in the economy the same way kind of look at the financial planning, save now, better for later. Anyway, so, okay, the elephant in the room, the Jackson Hole Symposium, and let's get right after this. So Powell had some comments, and
right.
Mike, we want your thoughts. First of all, tell us a little bit about what you felt they were indicating, and then maybe a little bit about what that might mean.
Yeah, first I'm going to touch on some of the economic data we got this week, because it just plays into that narrative so much. So housing continues to slow over, new home sales down 12.5% on the month. Manufacturing declined modestly to 51.3, so it's still hanging on to expansionary territory. However, the non-manufacturing component of the flash PMI came in below expectations and is firmly in contractionary territory. So just to clarify what the flash PMI is, it takes about 85% of the participants that they survey. So not the full amount, but it's a pretty good indicator of what we'll get in the ISM. Durable goods orders came in flat for the month, well below last month's 2% increase. So part of the economy is showing signs of weakness, but like we've been seeing, employment continues to remain strong. We got another lower reading of jobless claims yesterday. This was a second straight week of that. GDP for Q2 was actually revised up slightly to -0.6. If you recall, it was -0.9. The interesting thing, though, is that gross national income was actually positive for the month. So it's kind of weird to see that much of a disconnect in those two. And then today we got the PCE deflator, which the Fed likes to use as their inflation metric. It doesn't have as big of a weight on the rental component as CPI does. So what we saw was the headline number came in line with expectations on a month-over-month basis. Year over year, that was 6.3. That was actually better than forecasters were anticipating. Core was also a little better on the month-over-month basis, only increasing 0.1%. So that beat expectations. So overall, I saw it as pretty much in line with the CPI report, showing some signs that maybe inflation's rolling over, but I see the importance of watching commodity prices because they will affect that in the coming months, not necessarily September, but after that. So getting into the Jackson Hole, like I said, we've been hearing from different Fed speakers throughout the week, but today we got Powell's speech, which lasted for about 8 minutes. I think his intention in keeping it so short was to disallow any softer interpretation of it, to kind of get away from what happened at his last press conference. Right. So overall, I found it pretty similar to his recent meeting where he talked about inflation being way too high and that they would have to cause some pain in the labor market to get it down substantially. Powell, among some other Fed members, continue to try to convince markets that rate cuts aren't on the table for a long time. This is a process. It's going to be, they're going to have to continue to hike rates. So that was my big takeaway. But as you see from the market reaction, S&P is down about 2%. So they took it a little more hawkish than me, but they also took his last meeting as less hawkish than I did. So getting back into balance, I guess.
Right, exactly. Well, it certainly is interesting times, and we've addressed this in other Friday Lives, but the consistent question sentiment that we're getting right now is, well, is this a good time to invest? And in our response to that quite often is invest in what and how long. Overall, would we say with a good financial plan, with appropriate goals, reachable goals, with appropriate timeframes and the resources available? Yeah, we would say this is a good time to move forward with your financial plan. And it could prove. We don't know. It could prove to be one of those times where, geez, it doesn't feel great to be invested moving forward in your financial plan. But history might prove, like some of these other time periods that Mike was talking about, history might prove that it is a great time. So is it a good time to invest? Well, the question is, what do you want to invest in and for how long? We can help you work through that. That's what we do, is kind of coach folks through exactly what would be most appropriate for them for the time period and for the individual investments. So the answer to the question, is it a great time to invest? There's some qualifiers around that, but who knows? It's always a great time to move your financial life forward, whether it be for the short term or the long term, assuming you're using the appropriate time frames and those individual investment types within those time frames, those buckets, if you will. So, is it a good time to invest? I would have to say probably. But we'll see. But that's why we come out every Friday. Here's one of the big differences, Mike, and I think you'll agree with this, between 1980s, the 1981, for example, even the 1990s, even going back into the early 2000s. Here is what is different. The flow of information and the inflection points in all of the markets around the world, sectors, regions, types of investments, because of the flow of information, because of technology, those inflection points are much faster. Things happen very quickly. That's why we want to come out every Friday. I think in the 80s, we probably could have done this once a month. Of course, we wouldn't have had the technology to be on camera and that kind of thing. It would have been a phone call or something like that. But, we could have done it once a month and everybody would have been up to date. Maybe even once a quarter. Like, there's not that much change. But the inflection points are really quick. So join us every Friday, 12:30 p.m. Eastern Standard Time. This is live streaming, and of course, it's recorded. Mike will continue to not only give us some historical perspective as you did today, which was awesome. I love that. But also keep us current, almost up to the minute. Powell spoke this morning for 8 minutes on what's going on. So any other thoughts, questions, Mike?
No, that's pretty much it for me.
Okay, I'm going to run over to your hometown. I think there's a sign there that says "Home of Michael Kutch, CFA." Is it over there? I'll take a picture of it.
It should be over there somewhere.
Well, I'm going to be looking forward. Everybody have a great weekend. We look forward to catching up with you next Friday. It's about 90 degrees, and it feels about 95 out here in New Jersey. So I'm going to jump into the ice rink where it's nice and cool, watch my son play a little bit of hockey. So,
awesome.
All right, everybody. Have a great weekend.
Okay. Bye.